I'm Tyler Rudek, Chief Investment Officer at Boyum Wealth Architects. Interest rates have risen significantly, but one of the most important developments for long-term investors is the increase in real yields, the return a bond provides after accounting for inflation. This week, I'll walk through 3 charts that help explain what rising real yields mean for investors and portfolios. Chart 1 looks at real interest rates over time. The 10-year Treasury yield is currently around 4.7%, while its inflation-adjusted, or real yield, is approximately 2.4%. That is a major change from 2020 when real yields were negative and investors were effectively accepting a loss of purchasing power in exchange for the safety of government bonds. Today's higher real yields mean bonds can once again provide meaningful income and diversification within a long-term portfolio. Next up, we look at the stock market earnings yield. Higher bond yields also affect how investors evaluate stocks. The S&P 500 earnings yield is currently about 4.9%, compared with a 10-year Treasury yield of approximately 2.4%. When real yields were near zero, stocks face relatively little competition from bonds. Today, investors have more attractive choices for generating inflation-adjusted returns. This does not mean favoring one asset class over another. Instead, it highlights the importance of maintaining an appropriate balance between stocks and bonds. And finally, we look at the Federal Reserve balance sheet. The Federal Reserve's balance sheet remains substantially larger than it was before the 2008 financial crisis, even after declining in recent years. Further reductions could place upward pressure on Treasury yields and keep borrowing costs elevated for businesses and consumers. Along with inflation and federal debt concerns, this suggests that interest rates may remain higher than investors became accustomed to during the years following the financial crisis. And that is it for this week. The bottom line is that higher real yields can be beneficial for long-term investors by improving the income and diversification potential of bonds. At the same time, higher rates can affect every part of the market. A thoughtfully constructed portfolio, balanced across stocks, bonds, and other assets, remains essential for staying aligned with long-term financial goals. As always, please reach out if you have any questions, and thank you for watching.